Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Fred Soneya, partner at Haatch, to talk about the Haatch SEIS Fund. Hi Fred, tell me a little bit about Haatch and yourself first off.
So my name's Fred Soneya. I'm a co-founder and partner here at Haatch. We've been around since 2013, actually as angel investors, and we launched our first fund in 2018, which was our EIS fund. We did something really unique from 2013 to 18, is we actually built a venture-backed business whilst we were angel investing, and we raised money through both the SEIS and EIS schemes, as well as from Notion Capital, who are a tier 1 VC. And we successfully exited that business at the back end of 2018. So we had that real world experience of being venture backed. And that was on top of a previous exit, which enabled us to start angel investing in the first place. Fast forward to 2018, we launched our EIS fund, and we've been investing under the tax efficient schemes ever since.
And when you talk about us, who's us?
So founding team is myself and Scott Weavers-Wright. Scott was the founder of kiddycare.com, which was the largest independent baby retailer in the UK, acquired by Morrison's Supermarket in an all-cash deal back in 2011. And the team has now expanded to 18 people in full-time.
So tell me, what does Haatch look for in a company?
So we're very focused on businesses that have what we describe a pain in the present. So by that, our investment philosophy is around investing in businesses that are solving a real-world pain today versus some future problem or future perceived challenge. So when we speak to founders, we focus very heavily on the problem they're actually solving, and particularly on the buyer that they're trying to solve for. So when we speak to a company and they say, my dream buyer is Uber, or my dream person that I'm going to sell my software to is Salesforce, we actually push them further to identify who within that organization has a pain and why they're willing to pay for their product. And at the earliest stage, that's quite often pre-revenue. And at the seed stage, that's quite often with some revenue behind it, so some early proof points. We only invest in business-to-business software companies, so we don't invest in direct-to-consumer businesses. We love business-to-business software because it's metric-driven. We like metric-driven investing. We know what the Series A benchmark is in the UK to raise money. We know what the exit multiple should be. We know what the valuation multiple should be. But outside of that, we're vertical agnostic, investing in companies across all different verticals, but as long as they're business to business.
And how do you find these companies?
I think most people sit here and talk about how many thousands of inbound approaches they get each year. So instead of me quoting that, I'm actually going to focus on our outbound strategy. So over the last 18 months to 2 years, we've really developed our outbound approach. So we source thousands of businesses a year before they go on the market. So our kind of remit for our SEIS fund is if a founder is raising on LinkedIn, it's too late. We should have already spotted them, already spoken to them. And we take data sources, things like Companies House, new companies being created, things like LinkedIn updates, someone's left a job as a VP at Google and they've created a stealth company or a new company. And we outbound people really hard and we sell them on why they should work with Haatch and why they should be interested in taking our money. In addition, of course, inbound, as well as partnerships with accelerators, other VCs, and I think the space generally is very collaborative.
How many companies typically would you look for to invest in a portfolio?
So we build our investors a portfolio of 9 to 15 companies per tranche or per fund, and we raise on average 2 to 3 SEIS funds a year. So a typical investor will invest in a couple of those a year with us, so we'll end up with a portfolio of around 30 companies. To build that portfolio of around 30 companies across 2 funds, we're seeing thousands of companies and taking hundreds through diligence and taking 50 to 70 to our investment committee.
And what exactly do you look for in these companies and the founders?
So on the founder side, we look for the founders' relationships. So we love investing in businesses which are multi-founder. We think it's very hard to build a early stage business as a single founder when there's so much to do. And we look at how these founders have worked together in the past, how they've known each other, where they balance each other and what the gaps are in the market for them or the gaps in their team. Ultimately, we have to support those businesses, and these founders do, when things go wrong. So that's really what we're focused on. When something goes wrong, is this the team we want to back? Outside of that, like I mentioned earlier, we're focused very much on real world pains, not some kind of future world challenge or future world problem. And then we're focused on runway. I think the last couple of years, revenue has become a sexy word in venture again, which I'm very excited about. So we're focused on runway and revenue, because ultimately companies go bust when they run out of money. So at our point of investment, we ensure that every investment we make has at least 18 months runway and a clear path to that next round of fundraising.
And so how involved are you actually getting into these companies?
It's a great question, and something that's kind of evolved as our portfolio has grown in size over the last few years. We no longer take a board seat in every company. We find that the most value that we add in early stage companies is actually on more of a day-to-day or week-by-week basis outside of a formal board setting. So we've built an incredible founder community where all of our founders can talk to each other. Whether you're building a health tech company in one vertical or a fintech company in another vertical, you've probably got the same problems, you've probably had the same challenges. Also, the area of expertise that we help on has really shifted over the last couple of years. A few years ago, we were very technology heavy, very focused on how we support with product roadmap, technology development. Now we're very focused on go-to-market and sales. And the real reason for that is we've seen in the market that technology's become democratized. It's easier than ever for somebody to build a technology-powered business. And actually the real difference, the real USB, is how you get to market, how you price, what your sales motion looks like, what your conversion rate looks like. And that's where we're really focused. And to do that efficiently, we ensure that every portfolio company has one person within Haatch who's their point of contact, who's their day-to-day. That doesn't restrict them from the rest of the team, but it ensures that everybody has an owner. So although our portfolio is quite large, now almost 100 companies, I have 15 companies that I'm the owner for. I'm responsible for ensuring that my cadence with them, I check in with them regularly, and that I'm providing all the support that they need, and then feeding the rest of the team into it as and when they require.
And can you give me some examples of recent investments?
Sure. So we just invested in a company called Social Tip. This was quite a high-profile investment. The founder was James Watt, the former founder of Brewdog and CEO, a multi-billion dollar valuation company now. And this is a great example of us finding a company early. So Social Tip are about to, when they launch, empower brands to monetize their customers' social media. So instead of paying an influencer to promote a product, your actual best influencer is real verified purchasers, people who are buying products from you, truly buying products from you, loving them and sharing them with their friends on social media. And we did Social Tip's entire SEIS allocation. So our SEIS fund took all the SEIS allocation of £250,000, and we invested in Social Tip ahead of them launching on Crowdcube and ahead of them raising money from any other investor. So the round ended up being £2.5 million. Very high profile. They filled the entire round in a weekend when they went on Crowdcube. Most successful pre-launch campaign in Crowdcube's history. But importantly, we were in there first. We already had our allocation. We'd already locked in the SEIS. Second deal that I really love that we've done recently is a business called Cybaverse. I like this deal because they were SEIS qualifying, but already had £1 million in revenue. So quite a unique scenario, but really kind of shows that motion that actually SEIS doesn't always mean the earliest stage of company. And this business is in the cybersecurity space. And what they've done really well is they've used consultancy to drive revenue and to enable them to build a SaaS product, which now they're starting to convert their customers in from consultancy customers to now SaaS product users. So I think two great examples of a later stage business in terms of revenue, but still SEIS qualifying, and then a very early stage business that we sourced offline before it kind of went mainstream.
And how about some of the companies you've backed over the last few years? How are they doing?
So we invested in a business called Popp about 12 or 13 months ago. Popp are an AI business focused on recruitment. So they enable recruiters to filter, research and organize literally millions of CVs and unstructured communication. We invested in them. They were doing £1,000 a month in recurring revenue. Fast forward 12 months, they went to market to raise a seed round. They closed a £2.5 million seed round from some tier one VCs within 6 weeks of being in market. They're doing £25,000 a month revenue, so a significant increase in the last year and a great uplift for our underlying investors. Another company that I'm really excited about is Ningi. So Ningi are a vertical SaaS platform, and this is an area that I like a lot. So they're focused on an entire vertical, which is independent financial advisors or IFAs, and they're an operating system enabling IFAs to run their business and scale their business. That business we backed originally from our SEIS fund a couple of years ago. They've gone on to raise from our EIS fund last year, and now they're valued at about a 3x uplift for those early SEIS investors. So significant uplift, and what's true about both of those companies is significant focus on revenue and great funding for the future.
Okay, and what about the risks? It's a very risky area of the market. How many companies would you expect to go bust? Have you had a lot of companies going bust?
So I think SEIS is particularly risky, for sure. I think there's a couple of things that we can do to mitigate that. So SEIS is not always the earliest of stages. Cybaverse is a great example of that, a business already with substantial revenue. And also building a diversified portfolio of 9 to 15 companies per investor helps mitigate some of that risk. However, of course, we're going to have failures, and we have had failures. It's very hard to put a number on it at this point, given the SEIS fund's only 3 years old. In the entire Haatch history, less than 10% of companies has failed, but I appreciate that failures comes first, and of course, the more investments we make, we're likely going to have more failures. So our internal modelling is a portfolio of 15 companies. We'll probably achieve somewhere in the region of 50% of those will return less than 1 times money invested over the course of 5 to 10 years. But of course, it's the outliers that drive the returns in venture capital, and it's the outliers that deliver those multiples on investment.
And have you had any exits yet?
So our portfolio is only 3 years old. Our oldest company in our SEIS portfolio has just passed the 3-year SEIS mark, whereas 80% of our portfolio is sub 3 years. We've had a couple of exits below 1x, kind of downside scenarios, but no exits as of yet. Our focus is on liquidity, of course. However, 2 things I'd say is, one, our holding period target is 5 to 10 years. So I think it's still a little bit early to be focused on kind of home run returns. And secondly, we want to be ensured that we don't sell early. So what we've seen in the market is by selling early, you limit your upside. And in venture, we really want to go for those home run returns. We really want to go for that long-term upside. So majority of the portfolio less than 3 years old, big focus on liquidity over the next couple of years, especially as we kind of come out of that 3-year SEIS window. And we're very hopeful with how the portfolio is looking.
And finally, Fred, I think there's a lot of people who want to invest in SEIS this year. Why should they choose Haatch?
They should choose Haatch for a few reasons. One, every single member of the Haatch team is entrepreneurial or operator background. Everybody's been in a real business or run a real business. We understand how business works. 2, British Business Bank invest in every single deal that Haatch does. Every time we make an investment, we invest now £85,000, up from £60,000, in every single SEIS company from our partnership with British Business Bank. That's £10 million, and we're looking to expand that next year with another £10 million. Thirdly, we do not charge portfolio companies fees. I'm so passionate about this. We are the only SEIS fund in the market that does not charge founders fees. I do not believe that a portfolio founder, the best portfolio founder, is willing to pay to raise money into their business. I think it's our privilege to be able to invest in their business. And I don't think that them paying 5 or 10% to their fund manager for the privilege of them investing makes much commercial sense for them. So we do not charge portfolio fees. And the 4th thing is us as partners have invested in every single SEIS tranche to date and will continue to do so. Of course, as our AUM grows, our proportion of AUM will come down, but we are aligned, we have skin in the game, and we're fully aligned on creating investor returns because that makes ourselves money as well as our underlying investors.
Fred Soneya of Haatch, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.